The strategy of 10 EMA is called as a magical strategy. Why? Because this strategy can be used in intraday to buy and sell. This strategy can be used for option trading, for long call, long put, short call, short put. A 10 EMA strategy can be used for swing trading, and a 10 EMA strategy can be used for long term trading. Depends on which kind of chart you are using. But other than investing, 10 EMA can be used for any other trading strategy in short term as well as long term time frames. Hi friends, Professor Joe here. I hope you all are doing great and welcome to this video. In this video, we are going to discuss why 10 EMA strategy is called the magical trading strategy. Now, what is a moving average? A moving average is an average point of the last X number of candles. Now, that X number of candles can be 3 candles, 5 candles, 10 candles, 20 candles, 50 candles, 100 candles, 200 candles, whatever it is. Okay, that's why I'm using X candles. And every time the price keeps going ahead, a new point is created. And when a line is drawn connecting all these points, then a moving average is formed. Now, which point should be considered for using a moving average for the average point? So, most important is you need to understand that every candle has 4 points: the open, high, low, and close. Normally, the closing point is used to calculate the moving average. But there are people who uses other points also. But why closing? Because at the end of that particular time frame, you know what was the psychology of the people for that particular time frame. That is why closing is always considered as a better option. Now let us take an example of a 10 EMA, how a 10 EMA would be calculated. Like you can see in this, we have taken 10 points, which are closing points of 10 candles: 80, 81, 82, 83, 84, 85, 86, 87, 88, 89. Now, when you add up all these points, what happens? You get a total 845. Now, how do you take the average point out of this? You divide it by 10. So when you divide it by 10, you get an average point. So your next point is 84.5. So you got 1 point. Now you're looking for the next point to come. So the next point would be 81 plus 82 plus 83 plus 84 plus 85, like that, plus till 90. The total of that is coming to 855. If you have to remove the average, you again divide it by 10. So you get 85.5. Like these points keep on getting generated as the price goes up or down. And then these points are connected using a line and the moving average is created. Now, in this example, we have taken an average of 10 EMA because we have considered 10 previous points. Like that, an EMA can be of multiple candles. It can be 10, it can be 20, it can be 50, it can be 100, it can be 200, whichever the trader want to use. Since we are looking at the magic of 10 EMA, we are using this formula of 10 numbers. When we talk about moving averages, there are multiple types of moving averages. Like SMA means simple moving average. EMA means exponential moving average. Then there are other moving averages like smoothened moving average, weighted moving average. People normally do not use that, but there is not much difference in it. Even in an SMA and EMA, there is not much difference. In SMA, every single point that is taken for calculating the average point is given equal weightage. So the SMA moving average moves a little bit slowly. It reacts a little bit slowly. Whereas EMA gives exponential weightage to the latest points. So the average quickly changes. We will look at the chart. You will come to know that there is a minor change when EMA is used above SMA. So because EMA gives exponential weightage to the latest points, that's why the price movements are quickly shown by EMA. That is why in a short-term trading, EMA can be preferred over SMA. Like you can see in this chart, in 2 points where the price movements are changing, you can see the red line, that is the exponential EMA, is quickly reacting a little bit. But overall, if you go to see, the red and the blue line is almost moving together. So there is no major difference, but still I prefer EMA. It is up to the trader which they are comfortable with to use. In this example, we are using the EMA. Now the 10 EMA strategy is a very simple trading strategy, but a very effective trading strategy. It can be used on any time frame, 1 minute, 5 minute, 15 minute, 30 minute, 1 hour, 4 hour, daily, weekly, monthly, whichever you want. You also can use it on any financial instruments like stocks, forex, commodity, crypto, whichever you want to use, it can be used over there also. I prefer using candlestick charts because it is more clear. There are traders who use bar chart and line chart also, but I personally prefer candlestick chart, and I'm going to show you an example using candlestick chart only. Now the strategy is very simple. Once the candles start moving above the 10 EMA, you wait for 2 to 3 candles and let the candles go a little bit away from the 10 EMA. Then you wait for one retracement candle. The next candle after the retracement candle should be in the direction of the trend. So if we are in a bullish direction, the candle after the retracement candle should be in the direction of the trend. Once that candle is complete and it is in the direction of the trend, you place a buy. If it's a bullish call, you place a buy over the bullish candle and a stop loss at the EMA point, which is exactly below that candle. And you put a risk to reward of 1:2, so that the distance from the top of that candle till the EMA, your reward will be 2 times of that. The strategy is very simple. This is a simulation of that strategy. I've taken a screenshot from a chart, and here you can see very clearly that these are few candles going above the 10 EMA. You can see that there is one retracement candle. The next bullish candle, at the end of that candle, you go for a buy entry. Your stop loss is the point exactly below that bullish candle on the moving average. You check the distance and your risk to reward is 1:2. So as the price goes up, you can see first it reaches 1:1, you wait. Then the price continues upwards. When it reaches 1:2, you exit. I know that the price continued going upwards, but we have a different strategy for it. But the most important thing is you practice one simple strategy multiple times. And then once you become an expert, then I will show you what to do next. This is a simulation of a bearish call. You can see after the 2 big candles, you see a retracement candle. But the next bearish candle was very small, so I would wait. After that, the second bearish candle was a very good candle. So I went for a sell call at that candle. And the stop loss is exactly above that on the moving average. And then as the price goes down, you exit at 1:2. Now to become a successful trader, you need to practice this strategy at least 100 times. You continuously practice this strategy on your favorite financial instruments. It can be stocks, it can be indexes, it can be forex, it can be crypto, it can be commodity. Use it in options, whichever you want. Use it in your favorite financial instrument and become an expert in it. Now, once you have become an expert and you realize that the price normally moves in that particular direction for quite some distance, even after you exit, then there is something called as a trailing stop loss, which you can use. A trailing stop loss is where the stop loss moves ahead along with the price movement. So if the price moves up by say 10 pips, the trailing stop loss will also move up by 10 pips. The price continues another 10 pips in the same direction, the stop loss also moves ahead in the same direction. And if the price reverses from there, then the stop loss remains there and the stop loss is triggered. A trailing stop loss is extremely beneficial when the price is moving in that particular direction for some distance. It becomes very beneficial because the trader gets a lot of reward when the price moves in that particular direction and does not retraces back and hit the trailing stop loss. Now, the distance between the price movement and the trailing stop loss, everything can be adjusted. We will have a separate video on how to set a trailing stop loss. As of now, this is a simulation here which I have shown. There is an entry point. You put a trailing stop loss exactly below the candle on the moving average. And then as the price is going up to reward 1:1, your trailing stop loss move to break even. Then as the price moves to reward 1:2, your trailing stop loss moves to reward 1:1. Then as the price moves to reward 1:3, the trailing stop loss moves to 1:2. As the price moves ahead, reward 1:4, the trailing stop loss moves to reward 1:3. As the price moves forward to reward 1:5, the trailing stop loss moves to 1:4. And it keeps going like this to 1:7, 1:7. Here you see that the price is just not retracing back. And as the price is going up, the trailing stop loss is also going up, and it will keep going up till the price retraces and hits back the trailing stop loss. So once you know your instrument very well, whether it is stocks, whether it is options, whether it is currency, whether it is crypto, when you understand your instrument very well, then you can use the trailing stop loss to your benefit. As I said, the 10 EMA is a magical trading strategy. Why? Because the entry, the stop loss, and the exit, everything can be clearly given. And because it can be used on a 1 minute time frame, 5 minute time frame, 15-minute time frame, you can frequently enter and exit the trades. And the strategy is so simple. That's the reason it is called as magical trading strategy. So I hope through this video, I have been able to explain to you the 10 EMA trading strategy. In this video, we try to understand what is an SMA, what is an EMA, what is a 10 EMA trading strategy, and a brief touch on the trailing stop loss. Now remember, until and unless you practice it 100 times, you are not going to become an expert in it. And to become a successful trader, you need to have a lot of practice, patience, and persistence. Without these three things, you will never become a successful trader. So you have to do this. This is the input you have to give to become a successful trader. Now, I have written a book, Traders You Can Win, but First Learn to Lose. This book is available on Amazon and Kindle. This book talks about technical analysis, trader psychology, and two trading strategies. So, friends, if you are interested in buying the book, you know where to find it. And finally, if you love the content that I'm creating, please like and share these videos. So, like you, there might be other people who would like to learn such wonderful strategies in trading. They can benefit out of these videos that I am creating. I've created a lot of videos and I'll be creating many more videos. To get the latest update on my new videos, kindly subscribe to my channel. Friends, all I can say is keep learning, keep growing. Thank you. Namaskar.